Nígbà pé ọ́fíìsì ẹ̀ gangan ló ń lò.
Good morning, everyone.
Good morning, sir.
Good morning.
Good morning, sir.
Yeah, fine.
Good morning.
Okay. Yeah. Good morning, everyone. Today we'll be looking at, based on popular demand, we're looking at income taxes. We'll be looking at income taxes today, and it's one of the critical aspects of financial reporting, as we all are, that government is a stakeholder in the business. And in that situation, government also participates in having one of things derivable from every organization that is subject to tax. Tax burden has been a very huge burden on enterprises, because you are aware that in most jurisdictions, the profit of the business is subjected to as much as 2% more. Can we all move our system? Okay, and imagine you make profit and it's taking about 30% of it or more. You know it's very significant. And that's why you find that in the financial statement, we have to disclose income taxes as a separate. Barely do you see returns in terms of dividends up to 30% of profit most times, but government is taking 30% regardless of the situation. But the beauty of it also is that in the period of losses, government losses, and that's why you find out that tax losses are allowed to be carried forward against future taxable profits. The implication is that you are given a credit against future taxes, such that before you are subjected to additional taxes in the future, post-loss era, you'll be allowed to redeem all your losses by way of absorbing it before the excess over such losses can be subjected to tax. Okay, all of these are what we're going to discuss, and majorly, apart from the implication, how do you present it in the financial statement? Those are things we are going to discuss today. I still remember my humble self, Olumiwa Adebayo, and I'll be using this opportunity to now go into the course. Now, IAS 12 governs income taxes, and if you have to go by it, income taxes is not necessarily all the taxes a corporation pays with government. Okay, now let's start from the principle of taxation. Now, there's tax, there's taxation. Tax is more or less a compulsory levy you are bound to pay to government, either as a private individual, a body corporate, or a trustee. Okay, and it's compulsory, or because it is more or less required by law. The nature of tax is such that it is not paid on the basis of commensurate services enjoyed from government. No, it is paid out of compulsion, and that is the requirement. And that's the requirement of the law. Okay, in that regard, we need to understand what it is. Compulsion makes it a tax because you have no other cost to justify whether to pay or not. And that's why when I interact with people, I make them realize that you have no excuse for not paying taxes, whether government is delivering on the social goods or not, because it's not arising from a contract. If it arose from a contract, it becomes two-party considerations, which means you furnish your own consideration and government furnishes its own. But in this case, it's not a contract. It's an instrumentality of law that compel you to pay taxes. As I've said earlier also, in a write-up I put up, I said, even in the days of Jesus Christ, you find out that people ran to Jesus to complain about the taxmen. And he asked them that, what is being demanded from you? They said money. He asked them they should look at on the face of that money, whose face is there? And they said that's of Caesar. And he asked them, who are those guys? They said they are Caesar's agents. Okay, you have to give what belongs to Caesar, and thereby give what belongs to God, which means it has come to stay. And that's why there's this quote that says there are two things that are certain in life: taxes and debts. It's compulsion, whether you like it or not. And that's just what it is in the present world. But taxes varies in shape. And I'll try to more or less break it down. When we talk about taxes, what do we mean? When we talk about taxes, tax and taxation. Now, I've said earlier that tax is a compulsory levy. It's a compulsory levy on individuals, body corporate, and trustees by government or its agencies. Now, the word compulsion, as I've said earlier, is what matters. And what also matters is that it's not levied by Agbero, but it's levied by government or its agency. Anything other than that cannot be seen to be tax. But when we talk about taxation, we are talking about the system of tax administration. Even though we use it interchangeably, but that doesn't matter. It's just a matter of semantics. Now, what really now matters is that when we talk about taxes, it varies in shape. Now, when we talk about taxes, we'll look at forms of taxes on the basis of what are the bases of tax. What that implies is every tax is based on something. What is the reference point in which tax is charged? That's what we mean by the basis of tax. Now, in this situation, you are aware that tax can be levied on capital. Example of such is stamp duties. Tax can be levied on consumption. Example of such is value-added tax. Tax can be levied on tax. Tax can be levied on revenue. Tax can be levied on income. Can be levied on production or output. Means all of these are bases of taxation. Okay, now, but what matters most is income tax. And I'm going to explain why. IS 12 governs income tax only, but not all taxes that is faced by corporates. And why is that so? every other tax that is based on capital, consumption, revenue, and also on output are more or less accounted for in other IFRS standards. Whereas taxes that is based on income, and income in this case, we are talking of profit, or simply put, net income, is what IAS 12 deals with. Which means IAS 12 is not talking about taxation in generality, but it's only talking about income taxes. The question now is, what is income tax? Now, from our perspective, okay, I think I didn't share the screen, what's writing. Let me show you again. Okay, this is what I've written so far. I didn't share the screen, sorry. Okay, now, income tax by the position or requirement of IAS 12 deals with taxes or levies that are based on profits. Now, the standard makes us understand that when we talk about profits, profit is the matching of income and expense. What does that imply? It means profit is net income, which means any tax on income as a standalone, any tax on expense as a standalone does not constitute income tax. Likewise, any tax on revenue, asset, consumption, capital, or any other basis other than profit does not constitute income tax. Again, profit has different aggregate level. Now, profit could be gross profits. Profit could be operating profits. Profit could be taxable profits. Profit could be assessable profits. Profit could be capital gain. All of these are categories of profit or aggregate of profits. And any levy or charges by government on any of these variables will be considered income tax. Why? Because before arriving at this variable, you will have matched some level of income with some level of expenses, which give rise to a net income. And that now presupposes that we should look out for what are the examples of taxes in Nigeria. Now, I want us to call them one by one based on what is known to us, and let's try and discuss it. Now, let's look at examples of taxes in Nigeria. Now, can we unmute and give me examples of taxes borne by corporations in Nigeria? One.
Value added tax.
Value added tax. Two.
Withholding tax.
Withholding tax. Three.
Capital gains tax.
Capital gains tax. Four. Somebody
Income tax.
NCD.
Okay. National Development in Technology Levy. Okay. What else?
NCD.
NCD. Okay. Local Content Development Levy.
Okay.
Education tax.
Tertiary education tax. Okay. Which other one? Yeah, many more.
There's this new one to support police, Nigerian police.
Okay, Nigerian Police Fund.
Yes.
Okay. Stamp duty. Which other one? Which other one known to you? Royalty. There are still many more. Dividend tax. Which other one do you know? Are you aware of NCC levy for telecoms? Also mention additional ones. Minimum tax. Custom duties.
ITF.
Excise. ITF is not a tax, it's based on training, contribution, which you benefit commensurately. Excise duties. Okay. Custom and import duties go line in line. What other ones? Property tax or tenement rates. Business premises levy.
Development levies.
Development levies. What again? What again? Do you have as taxes? Most of you work in finance companies, finance department of your company. You should be aware of many of all these taxes.
What about direct assessment?
No, that's an assessment. That's the basis of subjecting individuals to tax or high net worth. That's not tax itself.
Yes.
Okay, which other one? I want to ensure that we have, okay, I think we've not mentioned PPT, Petroleum Profit Tax. Okay. Which other one to close it up at 20? Who is going to break the ice by giving us the 20th one? Okay, let's just pick all these radio, TV, licenses, and these are taxes to local governments. Is that not?
Yes, sir.
Okay, let's assume that these are all the taxes exposed to corporates in Nigeria. The question then is, of all of these taxes, which one constitutes income tax? If you go by way of definition.
So we are yet to put education tax, sir.
Sir? What did you say?
Education tax.
Okay, wait, let me.
Is it there? Education.
Education is a tertiary education, TET. TET, tertiary education tax. Yeah.
Okay.
Now, if you remember, we said income taxes are taxes levied on taxable profits of a corporate. Now, the question then is, profit is key. And who are people praying? Okay, can we all mute? Okay, thank you. Okay, And profit, remember we said it is when we compare some level of income to some level of what? Expenses. Now, if that is the case, let us look at these examples and ask ourselves, is VAT an income tax? VAT is not an income tax. Why?
No.
Because the basis is not profit. The basis is the value of goods and services. Withholding tax, in its real sense, is not income tax. But I'll still put question mark beside it, which I'll come back to later. CGT, capital gain tax, what is the tax based on? It's based on excess of your sales proceed over the cost of the assets, which means you are matching income arising from sales proceed to expense arising from cost of purchase of such an asset, which means it is an income tax. Company income tax, that is straightforward, is based on your taxable profit for the year. Nigerian Information Technology Development Levy is based on accounting profit, or what we call the net profits of every company operating in IT industry or financial institution. That is an income tax because it's based on profit. Now, NCD is based on the value of contracts and dealings with upstream entities based on local content. And that is not an income tax because it's based on what is not profit. Education tax, tertiary education tax is based on accessible profits. Therefore, it's an income tax. Nigerian Police Force Fund is a new development which is based on, I think, 0.5% of accounting profits. Okay, and I think it's to operate for about 5 years. Since it's based on profit, for entities that more or less to bond such will more or less recognize it as income tax. Stamp duty is based on value or fixed rates based on instrument or contract or documents. Therefore, it's not an income tax. Royalty. Royalty is based on production or output. It's not an income tax. Dividend tax is not an income tax, but in the same vein as in withholding tax, I'll put question mark. We'll come back to that. NCC levy is a revenue tax by NCC on telecommunications. I think they charge 2% on the revenue lines of all telecommunication companies. And that is not income tax because it's only subjected to revenue and not profit. Minimum tax is paid when you don't have sufficient taxable profits or where you have no taxable profits. Also, it's not an income tax, but I'll put question mark. Later on, we'll discuss that. Custom duties are based on value of importation. It's not an income tax. Excise duty is based on value of output within the locality. It's not an income tax. Property tax is based on the value of an asset. It's not an income tax. Business premises is based on the number of locations in which you operate within a state. It's not an income tax. Development levy is based on number of staffs. It's not an income tax. Petroleum profit tax is based on your chargeable profits. In an exploration and production venture, is an income tax because it's based on profit. Radio licenses, these are based on your use of radio, TV, and all sorts of things. It's not an income tax, which means invariably, what constitutes an income tax vividly here are capital gain tax, company income tax, Nigeria Information Technology Development Levy, tertiary education tax, MPF funds, which is a levy, and petroleum profit tax. Okay, that will now take us back to our extensive discussion about income tax. What we have successfully done in this case is to expose us to what really constitutes and income tax. Now, income tax comprises of two components: current tax and deferred tax. Now, when we talk about current tax, I will tell you that current tax is the actual amount of taxes that is charged on the actual performance or profitability of that company in that particular year. And every element of current tax is derivable from applying the relevant tax laws to the performance of the entity for a particular financial year. Now, for example, in Nigerian context, the provision of SITA and tertiary education tax and CGT and PPT more or less determines the amount of current taxes, which represent the actual amount of tax expected of an entity to be paid to the relevant tax authority for a given financial year. In that sense, it means it's the instrumentality of the law, tax law, that will determine the amount of current taxes, because tax is derived from legislation. Okay, but conversely, deferred tax tends to capture what is left out by current tax. Now, the totality of a tax impact is not necessarily recognized by current tax. What it then means is that current tax only recognizes the actual amount required to be paid based on the requirement of the law. But the total consequence of taxes is what is required to be recognized from financial reporting perspective. Remember, yesterday we introduced ourselves or refreshed ourselves with the understanding of accrual basis of accounting. And on that basis, what happens is that we only recognize expenses when it is incurred, not necessarily when it is paid, which means actual tax is about what is expected to be paid, which is current taxes. But the totality of income tax is both that is being paid and those that has occurred but yet to be paid or will be paid in the future. We then bring us to understand of deferred tax. Deferred tax is a portion of the income tax that is not recognized by current tax. Deferred tax thereby represents the future tax consequences that has not been captured by current tax. And by the time we move on, we'll be able to demystify what deferred tax really means. But one thing that must come to our senses is that deferred tax represents an accounting measure of the future consequences of our actions today as it relates to tax. And we are going to see that as we move on. But the first thing we need to do is to concentrate on what is current tax. Now, as I've said earlier, current tax represents the actual amount payable to the tax authority in relation to your operations for a financial year. And simply put, current tax is derivable from taxable profits, having applied the relevant tax rates. Now, but I want us to refresh our memory back to the days where we carry out tax assessments. Okay, I'll share a slide with you now. Okay, let me share the screen and let's go back to our memories of how do we arrive at taxable profit? And this perspective will be in line with the requirement of Company Income Tax Act. Okay. Basis of current tax computations. Now remember that based on the requirement of CETA, our assessment of tax will start from what we call the accounting profits. And alternatively, accounting profit is profit before tax. Now, let us assume that our accounting profit is 10 million. Now, we are required to carry out what we call tax adjustments. Now, the tax adjustments, I can group them into three. There are adjustments that requires non-taxable income. That is, some income has been recognized in this 10 million, which are not taxable. Either way of being totally exempted from tax, or they will be taxed in the future when the income is actually received, or the income has already been taxed prior to now based on the principle of cash basis. All of these are what constitute non-taxable income for that particular financial year. If that is the case, it then means that such amount of income, which is included in this 10 million, have to be deducted. Let us say it's 1,000 naira, 1 million, or figure in 1,000 in this case. Also, we have issues that borders on non-allowable expenses. Non-allowable expenses are either expenses that are completely disallowed for tax purposes, or because they fail to pass the rent test. If you remember what rent is, expenses are allowable for tax purposes only if they are wholly, reasonably, exclusively, and necessarily incurred in carrying on the business of the organization. Also, there are some other expenses that are not allowed or considered disallowed, not because they are not genuine, but because they might have been recognized in the past or allowed in the past on the basis of cash basis, or they will be allowed in the future when it is actually paid rather than when it was accrued for, or surrogates such as depreciation. Depreciation is disallowed or because it will be replaced by capital allowance, which we call tax depreciation. Therefore, all of these categories of expenses are what we can subgroup as non-allowable expenses. And in that situation, every non-allowable expenses has reduced the amount of our profits. Therefore, what do? You add it back. Adding it back means that they shouldn't have been deducted in the first place. And if that is the case, let me say it is 500. I add 500 back. Also, we might have issue of omission. Omitted allowable expenses. What does that mean? What this means is that from accounting perspective, expenses are recognized as it is incurred, not when it is paid. Therefore, there are some expenses that for accounting purposes have to be capitalized and recognized over time. Example is if you prepay some cost. I paid rent for 3 years and I have to only recognize a portion of a year in the books. But if the tax law requires that expense is only allowed based on the actual payment, it then means that the old 3-year rent is what I'm supposed to recognize as a charge. Which then means for tax purposes, the 2-year that were suspended or capitalized will be deemed to have been omitted as an expense for tax purposes. Similarly, IS 38 requires us that when we have a research cost, we should expense. But when we have a developmental cost after passing the relevant test, we should capitalize. In that situation, what happens? We've done that. Our R&D cost us 5 million, of which 1 million has been expensed by research, 4 million is capitalized by development. But for tax purposes, R&D is deemed to be an expense that is actually incurred for tax purposes, which then implies that the entire 5 million have to be deducted for tax purposes. In that situation, since it's only 1 million was deducted from accounting perspective, the 4 million difference will be deemed to have been omitted allowable expenses, which will now be subjected to additional deduction, which in this case will be deducted to reduce the profit. The final group is income that are deemed omitted. Now, income deemed omitted are items that are not recognized as income in the books for accounting purposes, but for tax purposes, such items were considered an income for tax determination. Example is any income you receive in advance is termed deferred revenue or deferred income or unearned income, which constitute a liability for tax purposes, for accounting purposes. But for tax, such income, if the principle of our taxation says every income received will be subjected to tax in the year it is received, it then implies that even though you have not earned the income, somebody has paid you rent for 2 years. In accounting, you have only recognized rent of 1 year and you have deferred the other 1 year as a liability. But for tax purposes, such deferral will not be acceptable because the law has said that income received should be taxed in the year it is received, regardless of the period in which that income relates. In that situation, what then do you do? Is to ensure that you now bring that income into recognition for tax purposes. And take note, bringing it into recognition for tax purposes this year presupposes that next year, such income, even though recognized for accounting purposes, will no longer be subjected to tax, which means next year, such an income will now be classified as non-taxable income, or because it has been subjected to tax in the prior year. Therefore, in this case, we adjust it and bring it forward. Let's say 1.2. if that is the case, when we sum this up, let me get my calculator. I have 500 plus 12 minus 1,000 minus 4,000. Therefore, in summary, my net adjustment is 3,300. Invariably, this gives me my assessable profit, or my profit adjusted for tax what purposes. And that should be 6,700. Now remember, as I've said earlier, when you make profit, government participates in that profit. Likewise, when you make losses, government will also participate. In that situation, losses that were made last year and carried forward to this year will invariably be brought what? Forward. Let us assume last year we made 500 taxable loss. It then means that this year we'll be able to relieve the 500 such that the assessable profit is sufficient to absorb the entire 500. And invariably, what it means is that my profits subjected to tax will be after I've taken credit for the tax losses brought forward from last year. Next, we have capital allowance. But peradventure, we are unable to carry to absorb all the losses. Any balance that is left will be carried forward to the next year. Next is capital allowance. Now, capital allowance also, you might not have absorbed all the balance last year. Therefore, any portion brought forward, let's assume we brought forward 200 from last year. Our additions for the year, let's say it is 1,000. That gives me 1,200, which means I have enough profit sufficient to absorb this 1,200. Therefore, nothing to be carried forward. And by the time I deduct 1,200 for my 6,600, what will now be subjected to tax, being my taxable profit, is 5,000. Okay. Now, given that this is my taxable profit, my estimated taxes for that year will be as follows. 1, my CIT, given the rate of 32% on 5,000, that should give me 30% of 5,000. That should give me 1,500. 2, tertiary education tax. 2% of, if you remember, what's our assessable profit? 6,700.
700.
2% of that is 134.
134.
Okay, let's say we have information technology development levy. 1% of my accounting profit. What's my accounting profit?
1% now.
My profit before tax, 10,000. Invariably, that give me what?
100.
100.
100.
What do we have? We have
1734.
1734. Therefore, this amount invariably represents our current taxes.
No.
Which means, as a company, for this financial year, what you are going to self-assess and file and expected to pay to the Federal Inland Revenue Service will be 1,734,000 naira. Okay, but take note, I still emphasize that it is an estimated tax. It is what? An estimated what? Tax.
Estimated tax.
Because why is it estimated? It's not final and conclusive. Remember, it is only final and conclusive if it is deemed so by the relevant tax authority, even though you guys might challenge it, and there's always a source of remedy, whether through tribunal or through court, if you dispute it. Okay? It is final and conclusive only when the tax authority accepts it in full or by order of court or tribunal based on your petition. Okay, that is the position. And that takes us back to actual taxes. Okay, let me go back to the main screen. Now, which means that current tax is the amount actually payable or recoverable to the tax authority in relation to the trading activities of the entity during the period. And we have demonstrated the understanding of what constitutes a taxable profit. And taxable profit will always be determined with reference to the relevant tax laws, which we have demonstrated in that case. Okay, now the beauty of it is this. The position of our tax is not conclusive, or because it is self-assessment. Now, because of that, and because of law, always have gaps of interpretation and gaps of judgment. Therefore, every position of a tax as estimated is considered to be uncertain. What brings about the uncertainty is the gap or the lacuna that exists between the law. For example, the tax law says that expenses are liable once they are only reasonably, exclusively, and necessarily incurred in carrying on the business of the enterprise. But the question is this: is a judgment call for certain expenses to be considered only, to be considered reasonably, and etc. from different perspectives? Every business has a justification to tell you that these expenses are only reasonably incurred. While from the angle of the revenue authority, who is also trying to maximize its tax revenue, might also disagree that certain expenses are not necessarily incurred. The question then borders on, as at the time I'm assessing myself to tax, that was the judgment call I made. And a year after, when the tax authority subjected it to examination, they are saying otherwise. And most times, after reconciliation arguments, objection, and etc., we always come to a different level ground whereby we both shift. And that shift always causes an adjustment or usually an additional assessment to taxes. And in that situation, it creates an uncertain tax position. Now, uncertain tax position is a position that after the fact, based on new information, revealed to us that there is a change in the basis of our estimations such that the actual, which is now agreed with the tax authority, is different from what was estimated. And this is what gives rise to over-provisioning and under-provision for taxes. And the question then is, when you have tax of last year being under-provided for or being over-provided for, what is the treatment required? Now, the treatment required is very simple, which is in tandem with the provision of IAS 8. Now, if you remember, IAS 8 talked about accounting policies, changes in estimates, and correction of errors. Now, by provision of IAS 8, any resulting difference or adjustment arising from taxes is first considered as a change in accounting estimates. The implication of that is that when you have over-provided for tax last year, the amount so under-provided will have to be considered as an addition to your taxes for this year, which means that adjustment will be deemed to have occurred this year and not retrospective, which means it's prospectively adjusted for. Similarly, if your tax provision last year was in excess, this year you'll be given allowance to enjoy that reduction, such that excess of last year will be used to reduce your tax of this year as if it occurred this year. And that's what the position of the tax law, the position of the standard is, both IAS 12 and IAS 8, which then means that adjustment for changes in tax arising from judgment, assumptions, and other interpretation will be adjusted prospectively, not retrospectively. Okay, now if you recall, yesterday we did similar adjustment where we're told that the tax for this year was 2.1 million, but we observed, based on our dealings with the tax authority, that our tax last year was under-provided for to the tune of 400. You now find out that the solution that we profiled yesterday showed that our current tax should be the estimated tax for the year, which was 2.1, plus the under-provision of 400 for prior year. And that's what gave us that 2.5 million we recognized yesterday. And this is where we derive our understanding from of the application that we did yesterday. But let's also bear it in mind, which I'll come back to, that how do we present current tax in the financial statements? Now, as I've told you earlier, I'll share these slides again. Sorry. Okay, I'm unable to locate the slide. Okay. Presentation of income taxes. Now, income tax can be presented in the following order. The larger portion of it is presented within profit or loss. The other portion is presented within other comprehensive income, while the minute portion is presented within equity, and I will explain. Now, tax is the reflection. Income tax is a reflection of performance and transactions or activities that contributed to those performance. You find out that bulk of our transactions that result into our profitability are reported to profit or loss, which is the income statement. The question then is, the tax consequence of those transactions or performance should also be reported in the appropriate section where those transactions were reported. Which then means that for every tax incident on items reported to profit or loss, the tax must also be reported to profit or loss. Whereas for items that has tax incidents or consequence and they are reported within the other comprehensive income, their taxes should also be reported within other comprehensive income. And that's why you find out that in IS1, information to be presented in OCI are required to be presented net of taxes, or because the taxes will also be reported alongside. Finally, yesterday we also understood that there are some transactions that impact equity directly, but they do not pass through profit or loss or OCI. And if these transactions give rise to effect on income taxes, the relevant portion of the income taxes attributable to those transactions reported directly in equity will equally be shown alongside within equity. Which then means that you don't close your eyes to say every amount of income tax, you report it only in income statement. No. You must be able to attribute it to the portion which is much more significant that goes to profit or loss, the portion that goes to OCI, and the portion that might likely affect equity, which is very rare. And that's why for equity section, I'm going to asterisk it much more. Because in equity section, such impact is usually arising from a business combination. Okay. That's why it's very rare. Okay. Now,
Thank you.
okay, let me show you something from our MTN slide I was pointing out yesterday. I was trying to call it up. Just give me a few minutes. Can you see it? Hello? Can we see this?
Yes, sir.
Okay.
Yes, we can see, sir.
Okay. Now let's go back to this.
Yes.
You find out that the portion of income tax recognized in profit or loss was this amount, 5430. Is it not? Okay. Now that is in the income
Yes,
statement.
sir.
In the other comprehensive income, you find out that as they report items, they report them net of taxes. Can you see it here? Deferred and current tax effect on this foreign exchange movement,
Yes, sir.
which are now reported net of what? Taxes, provided they have tax consequences. And that's what we are saying. And peradventure, let us check statement of changes in equity if they have any impact, tax impact on it also. It's always very rare, except those arising from business combination. There's none here. There's none here. Okay, which that means that invariably from our discussion, you find out that it's common to have it in these two. It's common to have it to be grouped into portion of profit or loss and portion of what? OCI. Now let's come back to the uncertain tax position. Remember that when tax authority carries out examination or audit, and it resulted in additional taxes, let's say 10 million. They also add penalty. In Nigeria, I think penalty is 10%, which means they add another 1 million.
And interest.
And let's say they have what? Interest.
Interest.
Interest go for about 18.5 now, which 13.5% MPR rate plus 5%.
19%.
MPR is now 13.5, which means it's 18.5%. Let's now say that comes to about 1.9, for example, which means the demand notice by FRS to you will be how much? 12.9. The question then is this 12.9, is it income tax? Is it income what? Tax. Who can answer that question? Is 12.9 income tax? Can somebody answer that?
I don't think so. Just the additional tax component.
Okay.
I
Let's
think
start
it's,
like this. Okay. Yeah.
I think it's income tax because those are the penalties from not paying from the previous income. So it's just an additional tax incurred for not doing the right thing on time.
Okay. Now let's start like this. 12.9 is not an income tax. Neither is the interest an income tax nor the penalty. Let's go back to what is an income tax? Income tax is a tax that is charged on profits. Now, the only one that arose from profits is additional taxes, or because for there to be additional taxes, there's an adjustment against that profit, and that profit is not the appropriate profit. And that's what brought about 10 million. Remember, if tax authority do tax audit, they will now tell you that further disallowed item, further non-allowed item, all sorts of things. And they come out to derive another taxable profit different from your own. And it's because there's a difference between your taxable profit and their own that gave rise to that 10 million naira. Therefore, what is income tax there is only restricted to the 10 million. Penalty is not an income tax. It's simply part of your operating expenses. Because the basis of penalty is not profit. The basis is on the additional amount of tax that you are now vulnerable to. Likewise, interest on it is not an income tax. It's recognized as OPEX or as a finance cost, depending on your policy. Basically, it's always OPEX if it's not material. But given that it's material, it's a form of finance cost because the interest is charged on the basis that you add access to government fund, which you ought to have paid as at last year, but you add on to it because you didn't pay the appropriate amount of tax. And so doing, you have gotten an authorized credit from government at an interest rate of 18.5%. That's what it means, which means it is not in relation to your profitability. It's in relation to the borrowing you had with government. And penalty is in relation to the administration of examining you and deriving that you have not paid the right amount of what? Taxes. This is essential because in the examination, they might give you additional information that shows under provision for tax of 10 million. Alongside with it, there was penalty of 1 million and interest of 2 million. Those are the information they'll give you. They now expect you to adjust for it in the financial statement. Though all of the adjustments will impact your performance for this year, but must be presented separately. 10 million will be presented within income tax adjustments. 1 million will be presented as an adjustment to your administrative expenses, while 2 million will be an adjustment to your administrative expenses or your finance costs, depending on the policy of the company. Does that make sense to you or not?
Yes, sir.
Does it make sense?
Yes, sir.
Okay, that is that. Let's go back. Okay. Now that's what we try to explain there. Now let me take you to a simple practice question. Now let me give you these two practice questions. Question 1 and 2. Can we solve it side by side? Now, can we read the question? Question 1 says, given the following financial information as extracted from the accounting record of Farmola PLC, estimated income tax for the year ended at 4 December 2016 was 85 million. Income tax paid during 2017 in respect of tax for 2016, as agreed with FRS, stood at 90 million. Estimated income tax for the year ended at 4 December 2017 stood at 100 million. We are required to determine the appropriate amount to be reported for the year ended at 4 December 2017 with respect to the following: income tax and current tax payable. Now, can we try to attempt the question? Okay, what it simply means is this. We had last year estimated that our tax was 85 million. And this year, FRS came to do examination, and at the end of the day, they discovered that we under-provided by 5 million, which we have agreed and we equally paid the differential alongside with our initial 85 million. That make up 90 million. Now, this current year, we have also carried out our self-assessments and it gives us 100 million. Therefore, what do? We are told to show what would have been our income tax expense for the current year. Now, what will I do is to attempt solving the question as thus. I'm trying to share the screen. Now, what is our income tax? Remember, we said income tax is current taxes and what? Deferred tax. Now, in this question, we have no information about deferred tax, therefore I'll put it 0. Now, to determine my current tax, remember the estimated tax for 2017 was 100 million, whereas prior year there was under provision of how much? 5 million. How do I have about that 5 million? Remember, FIS final position was 90, whereas what I estimated was what? 85. Therefore, there's an additional tax arising from last year of what? 5, which give me my current tax for the year to be what? 105, which means my current tax is 105 for the year. And since I have no information about deferred tax, my income tax is what? 105. Now, the second question. The B says, what is my current tax payable? That is what will be reflected in the balance sheet. My current tax payable is a function of what is my opening balance, which is my opening liability. My balance brought forward from last year was 85. Remember, taxes are paid on a preceding year basis, which means when you estimate your tax this year, it will be deemed to be paid next year, which means that 85 was not paid last year. I brought it forward. Now, what was my charge for the year? Remember, 105 was our charge for the year. I'll bring it down, which shows my total liability should be 190. But remember that we're told that we have made payments during that year to FRS. How much was the payment made? 90. Which shows that what is left to be paid should, all things being equal, should relate to my balance, which will be carried forward. And this 100 will relate to the assessment of 2017 only. Why? Because FRS will not allow you to carry that 5 forward to next year. Why? Because that 5 does not relate to this year. That 5 primarily relates to last year, which means this 5 will be paid immediately. If you are aware, FRS will always give you like 14 days or 21 days notice of payment, all because it relates to prior year, which means it ought to have been paid now. Not going to be for the 100 to the next what year. And that goes with the suggested solution to that, which means what we recognize as income taxes in our financial statement is 105, and what we recognize as our current tax payable in the balance sheet is 100. Now, similarly, we can also use that same methodology for the second question. Now, the second question says, Paramount PLC financial information is as thus. Estimated tax for the year was 100 million. Over provision in relation to prior year was 10 million. Deferred tax liability opening balance was 5 million. Deferred tax liability ending balance was 3 million. We are now requested to show the amount to be reported as income in our profit or loss for the year. Simply put, what do we do? Question 2. Income tax. Is current tax and what? Deferred tax. Now let's start with current tax. The information given to us is that current year estimated tax for the year stood at 100. And we had over provision against last year. Over provision means we have paid more. This year, we'll use it to reduce our taxes to what? To 90. Thereby, I'll bring this 90 upward as my current tax. Now, deferred tax has been computed, even though we have not yet gotten to that level. But the deferred tax liability has been computed for us as thus. we are told that the opening balance let me take it off. The opening balance was, is it 3 or 5?
5 million.
5 million. Why the closing balance was what? 3.
3 million.
Now the question is our liability increasing or decreasing? Is our liability increasing or decreasing? My liability
Decreasing.
at the beginning was 5, at the end is 3. Is what? It's decreasing.
Decrease.
Yeah. By how much? By 2. Now, if you go back to conceptual framework, a decrease in liability is synonymous to what? Is synonymous to a recognition of an income. If you remember, can you remember?
Yes.
What is an income? An income is an increase in equity attributable to increase in asset or decrease in what? Liability. Are you getting what I'm saying now? Therefore, what does that show us? It shows us that our deferred tax here is an income or a credit of 2. And what then do? I deduct 2 because it's a credit against an expense. Therefore, what is my income tax? 88. Which then means that for that year, is 88 I'm going to show in my financial statement as my income tax. Now let's do a simple guesswork. I'm going to give you this. And the little understanding we had, let us use it to demystify this question. I want us to solve this question. I'll give us just 5 minutes to attempt solving this question. Are we through?
Three, sir.
Okay. Let's look at the question. Now, okay, let me snap the question so that I can have it before me. Okay. Asna PLC. Now we are required to determine the income tax expense. Remember, income tax comprises of current taxes and deferred tax. Now, if you check the question, in note A, they said deferred tax charge was 150. That means they've computed that for us since they know we have not gotten to the level of doing it ourselves. But to determine current tax, we need to do some workings. We are told that we have a taxable profit of 10 million. And our tax rates is 20%. All things being equal, our estimated tax will be 20% of 10 million, which gives 2 million naira. But we are given information that this 2 million naira was the tax for this year, of which last year we underprovided. How much did we underprovided? We provided 1.5 million, but thereafter tax authority did examination and we both agree at 1.6, which means we under provided the difference between 1.5 and 1.6, which is what? 100. Invariably, after adjustment, it means what you have is 2.1 million. 2 million for the current year and 100,000 arising from prior year. Therefore, that brings us to 2,100. Okay, I think we also have capital gain tax. No, that's not correct. We still have capital gain tax.
Yes,
Therefore, we need to also adjust. Remember, capital gain tax is an income tax. We have CGT, which is 10% of 300. That's how much?
30,000.
Therefore, we adjust this by putting 30. And that will give us what? 2,280,000. Who got that? Who got that?
I did.
Okay. B question says tax liability. Our tax liability are in two folds. Current tax liability and deferred tax liability. What is our balance brought forward? Remember last year we provided for 1.5 million. That's our balance brought forward. Additional charge this year is 2,130 for current tax. That gives us what? 3,630. And we made payments in that year 1.6. How do we arrive at 1.6? 1.5 we provided for last year plus additional 100 arising from additional assessment. Therefore, what is left to carry forward to our balance sheet is 2,030. Abi?
Yes,
Now, this 2,030 is made up of 2 million for estimated tax for the year and 30,000 for the capital gains tax. The 100 will have been paid along with the 1.5. That's how we arrive at 1.6. Now, the next one is the deferred tax. Deferred tax liability. We're given opening balance of how much?
250.
We have opening balance of how much? 250.
50.
Okay, balance brought forward 250. And charge for the year, the 150. Can you remember the 150?
Yes, sir.
Which means our liability has increased to what? 400. That's the solution to the short question. Any other questions so far?
Is Amoiwa?
Sir?
Yeah, just one question. Ordinarily, since they said that the deferred tax for this year is 150 and they give us an opening balance, one would have assumed that that payment is a reduction in the opening balance, that we only made part payment from the deferred tax liability accruing.
Okay. Now, that means by the time we move further, you have better understanding of it. Deferred tax does not result in cash payments. I said earlier, even though we've not discussed extensively, that deferred tax is an accounting measure. We are coming to that. Okay? It arose just from accrual to ensure that there's completeness in capturing all of the tax consequences. It does not involve outflow or inflow of cash. And I'm going to explain it as we move on. Is that okay?
Okay.
Any other question? Because this brings us to the end of current taxes so that we can now focus on deferred tax. Okay. Now let's discuss deferred tax. Deferred tax is an accounting measure, as I've said earlier, but is a measure that tends to reflect and capture future tax consequences of current period activities or transactions. What it simply implies is this. Certain activities are done today, but the effect of the tax not recognized today based on the requirement of tax laws. And certain transactions occur today, but their real effect is tomorrow. But for tax purposes, the effects are captured today. And if we go by a matching concept, the matching concept states that at every accounting period, we must appropriately match income and expense, so that for every income, all associated expenses must be recognized in the same period. And that's why you find out that matching concept and accrual concept goes hand in hand. And for you to appropriately match what expense to what income, accrual principle have to be followed in full. And to do that is the reason why we don't only capture the actual tax consequence in relation to the law, but we capture the total tax consequences. The difference between the actual and the total represents the deferred. What it simply means is this. You have tax credit that were not used this year. Supposing they were used, your tax will have reduced, but they were not used. It then means that even though they were not used, we still need to capture the effect of it, given that it may have been used, such that we reflect the actual tax burden for the accounting year with the performance of that year. And therefore, deferred tax is now this accounting adjustment that is necessarily required on the current tax in order to reflect the total tax consequence. And the beauty of this adjustment is that it's positive, it's negative, which means an adjustment is a two-way thing. Is it an adjustment to increase or an adjustment to what? To reduce. Now, let me give you a diagram, which more or less will try to explain further. Remember, most of us operate this is a typical Lagos road. Let me try and draw Lagos road. But required to smoothen the road, therefore, what do? We need to grade the road so that at least it is motorable. And in the process of doing that, where we have like hills, we cut it off with a tractor and we use it to fill the potholes. Take away the excesses, we fill the potholes. Excesses, we fill the potholes. Excesses like that. At the end of the day, what do you come out with? We come out with a road that is slightly motorable. Something like this. After what we have done. Now, similarly, that principle relates to deferred tax, which means you are not adding or removing from the entire stretch of the road. You are only grading. Grading means that you are trying to level up. Where you have mounts or eaves, you take away. Where you have shallow ground or valley, you fill it. And at the end of the day, things normalize a little until later time. Now, the same thing happens to deferred tax. You find yourself in a situation where your actual tax is not always a reflection of your performance, or because your performance follows strictly accounting principle. But your actual tax follows tax principles. And accounting principle varies slightly from tax laws with respect to recognition of transactions. Sometimes they have common ground, other times they have differences. And these differences is what always vary our accounting profits from our taxable profits. And that's why you find out that three key impacts differentiate our accounting profit from tax profits. The first one is the tax adjustment, if you remember. If you remember, tax adjustments, that is the first one, which can come in 4 variants. The second one is adjustment for tax losses. And the third one is issued as surrender capital allowance. These three represent the differences between accounting profits and taxable profits. And that can be attributed to differences between accounting principles and the requirement of the tax law. Now, what then do? We need to understand and recognize the fact that deferred tax arose from temporary differences. Now, difference means two things are not the same. And what are not the same? Accounting principle and tax laws. But what temporary means, it is for a while. It is not forever. Which means you might have differences, but the differences is just for a short period of time. Now, one thing is for us to know how short it is, when it originates, and when it's likely going to reverse so that we can be on a common ground. And what brought about those differences. Those are the concerns we need to have in order to appreciate deferred tax. That will now take me to the level of this diagram that tends to explain deferred tax as a whole. Now, I'll say deferred tax arose from temporary differences. Now, these temporary differences will later appreciate that it could either be taxable, temporary differences, or it could be deductible, temporary differences. Now, we start to build up questions. The question that I'll first of all ask is this: you are trying to explain deferred tax to me, but you are talking about temporary difference. Therefore, the question is, what are temporary differences? What are temporary differences? That's the first question. The second question is this: I'm told that temporary differences can take a shape of taxable or deductible. The question then is, when are temporary differences A, taxable, and B, deductible? Now, secondly, taxable temporary difference will give rise to recognition of deferred tax liability. Why deductible will give rise to deferred tax assets. Now, this is only when they've applied the appropriate tax rates. The question then I will also ask is, how are these determined? A, deferred tax liability, and B, deferred tax what? Assets. That's my third question. My fourth question will now be, what tax rates or rates are applicable? Now, my answers to these four questions will further make me understand this chart to say that though deferred tax arose from temporary difference, but temporary difference can either be taxable or deductible. And when it is taxable and I apply the normal rate of tax, what I obtain is deferred tax liability. But when it is deductible, and apply the appropriate rate of tax, what is being obtained is deferred tax asset. Therefore, to answer these 4 questions, we'll go in this order. Temporary differences. Now, temporary differences are differences arising between carrying amount and tax base of assets and liabilities. What simply put is this: given that we have an asset and we have liabilities, in this case, we compare the carrying amount to the tax base. We expect them to be equal if they align in principles. But we recognize that to some degree, they align in principles, therefore they are equal. But to most other parts, they do not align, which make it unequal. Now, when they are equal, it does not give rise to temporary differences. There was no difference in the first case. But when they are not equal, it gives rise to differences. And the difference could either be kind amount greater than the tax base or kind amount lesser than the tax base. The question then is, temporary difference arose only where the kind amount and the tax base of an asset or a liability are not the same. And why are they not the same? It's because the kind amount represents the basis of applying accounting principle in the recognition of the value of an asset, while the tax base is applying the tax principle and laws in the recognition of the value of an asset. Now, for the same transaction, but they are being valued and seen from different perspectives, based on accounting principle and based on tax principle. Therefore, that brings about that difference. But we all recognize that that difference is just a timing difference. The difference is usually a timing difference. That's why it is temporary. Timing in the sense that something occurs before other, but at the end of the day, they arrive at the same thing. Only that somebody is getting there faster than the other, but they arrive at the destination altogether. And that is what it means. But we'll demonstrate that understanding as we move forward. Any questions so far? Okay. Now, I'll put up a chart. That chart, I call it deferred tax matrix. It's a form of 3x3 matrix. Remember we said two things account for deferred taxes. assets on one side, liability on the other side. And again, it's either the kind amount is greater than the tax base, or the kind amount is less than the what? Tax base. Those are the two states of nature. If they are equal, there's no temporary difference and there's no deferred tax. But if they are not equal, is either one is greater or less than, and they'll give rise to deferred tax from two perspectives. Is it taxable or is it deductible? Now, where the kind amount of an asset is greater than the tax base of an asset, which you are going to see from a practical scenario, you find out that what is likely to give rise to is a taxable temporary difference. And I will explain with practical example. Now, if I'm able to accept this convention to complete other cells within this matrix, is very straightforward. Remember that assets and liabilities are always moving in opposite direction. The question then is, if I recognize that the kind amount of an asset is greater than tax base will result in a taxable temporary difference. What if it's not an asset, but it's a liability that has its kind amount greater than tax base? Will it still show me the same position as an asset? The simple answer and logic is no, because assets and liabilities do not move in the same direction. They are opposite in real sense, which then means that for assets to give me taxable position, liability will give me the opposing position, which is what? Deductible. In that case, I'll put here deductible. Similarly, let me return to my asset position. If from the asset perspective, when kind amount is greater than tax base, we consider it to be taxable. What if the kind amount is lesser than the tax base? What should we do? That means that it's going to take opposing position, which means it can be taxable. For it to be less, it would rather be what? Be deductible. Now, again, the same philosophy holds. If for a liability, it is deductible when the kind amount is greater than the tax base. What will it be if it is less than the tax base for that same liability? It will be opposing position of being taxable. And that is what we're trying to explain. Which means that in summary, I'll tell you that I have a taxable temporary difference under these two conditions. One, where the kind amount of an asset is greater than the tax base. And where the kind amount of a liability is less than the tax base, which is what this chart is explaining to us. It's explaining that at this point, at these 2 points, and at this point for an asset, kind amount is greater. At this point for liability, kind amount is less than, and that's what it means. Now, for it to be deductible, it is when the kind amount of an asset is less than the tax base, and when the kind amount of a liability is greater than the tax base. And that explains the temporary what? Difference. Now, the second or the third question says, since taxable temporary difference will give rise to deferred tax liability, how do we arrive at that conclusion? Deferred tax liability is a result of the tax rate multiplied by the taxable temporary difference. Which means if your temporary difference is 10 million and your tax rate is 10%, it will be 1 million. Okay? And deferred tax liability is a liability, which means it's a balance as at the end of the year, which you have to compare with your balance as at the beginning of the year. We are going to see that later. Also, for deferred tax assets, it's synonymous to what we have done earlier, which is the tax rate multiplied by deductible temporary difference. Plus, remember that an asset means there's an economic benefit expected, but it's not limited to deductible temporary difference. Remember, from our tax assessment, we recognize the fact that the tax law allows us to enjoy some benefits, such as losses we made in the prior year that are allowed to be carried forward to the subsequent years is a credit to us, which means an economic benefit to us to reducing our future taxes. Thereby, along with capital allowance that was unutilized or any other tax credits, all this will create a deferred tax asset. And therefore, to determine the amount of deferred tax assets, we must also recognize the effect of the tax rate on unutilized tax losses allowed to be carried forward, plus tax rate times unutilized tax credits, such as capital allowances, allowed to be carried forward, which implies that deferred tax asset is a recognition of the effect of deductible temporary difference on utilized tax losses carried forward and unutilized tax credit carried forward. Whereas deferred tax liability is only the recognition of the impact of taxable temporary difference. Does that make sense? Okay. Now, if it makes sense, let us briefly come here. And I want somebody to give me a little explanation or answer, as the case may be, on this question. This question 7. Who can tell us something about A aspect of the question? You can mute. I want contributions. Any contribution? Any contribution?
I would say temporary difference would be the difference between the assets carrying amounts and the tax fees that can be reconciled, or that is reconcilable in future, but the permanent difference cannot be reconciled.
Okay, who else have idea? Who have idea? Okay, though we've not discussed permanent difference, but the first thing that comes to my mind is that permanent difference are other than temporary difference, which means differences other than temporary difference. Now, the word permanent difference is likened to differences that arise between accounting principles and tax rules or tax requirements, which are not expected to reverse in the future. Any difference between you and somebody that can never cross paths is a permanent difference, which means it's like two parallel lines that will never meet. You understand? For example, for taxation, whenever you incur penalty for whatever reason, it is not allowed for tax purposes. It's not deferred, it's not allowed at all. But in accounting, it will always constitute part of your business expense, which means till tomorrow, until Jesus comes, it will be disallowed and it will never reverse. Such difference between accounting and tax is a permanent difference. But differences that arise from like depreciation and capital allowance, they are temporary differences because disalligning depreciation is not disalligning it in that context. You are only saying that instead of you recognizing depreciation in the way accounting principle allows, I'm going to recognize it from my tax perspective because depreciation and capital allowance are saying the same thing, only that they are using different bases of allocating the same cost over a certain period of time, which means such a difference is temporary because the same cost of assets of 10 million that you depreciate over 4 years is the same thing that will be given capital allowance for the same amount over 3 or 4 years. Are you getting what I'm saying now? And that is what we mean by permanent difference and temporary what? Difference. And mostly temporary difference arose from timing. It's because of the time lag. But permanent, there's no time lag. Forever and ever, that difference will always stand side by side. Okay. When we extend further taxable and deductible temporary differences. Who will volunteer? Who's going to volunteer? Or you want me to select people? Who is tribal?
So,
Alicia, oh yeah. Is Ali Shuaibu there? Okay. What about Nana? Is Nana willing to salvage us? Okay, who wants to contribute?
So I would say the taxable difference is that I know that taxable differences result in deferred tax liabilities, and deductible taxable. No, I'm wrong. This is just deductible difference, not deductible taxable difference. Okay. No, I don't know.
Okay.
I will say taxable difference arise when the carrying amount of an asset is greater than tax base.
Okay. Okay, now let me demonstrate with a little example of deferred tax. Practical example. Let me check one or two questions. Okay, let's look at this question 4. We purchased a plant for 500 million naira. Tax depreciation. I want to talk about tax depreciation. You know what we are talking about. When we talk about tax depreciation, we are talking about, sorry, I'm trying to see whether I can write on it. Okay, don't worry. So he's acting funny someone. I'm coming back. Okay, I think I'm back. Okay, now tax depreciation to date amounted to 200 million, and depreciation charge in the financial statement, which is the accounting depreciation, is 100 million. The income tax rate is 30%. Which of the following statements is or are likely to be correct in accordance with IAS 12? Now, let us look at this information one by one. What does IAS 12 requires from us? The first thing we need to note, I think question 4, there was a plant that was acquired. Plant is an asset. Is that not?
Yes.
And it costs 500 million. Is that correct? Capital allowance
Yes.
in form of tax depreciation that was charged was 220. Accounting depreciation was 100. Is that not? And we are told that tax rate
Yes.
is 30%. Is it 30?
It's 30.
Okay. Now, the first thing we need to ask ourselves is,
Yes.
is there temporary difference? How do we know? What is the carrying amount? Now, for accounting purposes, what would be the book value of that plant as at the end of the year? It will be the cost minus accumulated what? Depreciation. Is that not?
Yes, sir.
In this case, how much is that? 500
800.
minus what? 100. That will give us what?
400.
400. The tax base is the same cost minus capital allowance. Is that not?
Yes, sir.
What is the cost? 500. What's capital allowance? 220. What is left?
280.
80. Now, is there a difference? Are they showing us the same balance of value?
No, sir.
One is showing me 400 for the same plan. The other one is showing me what? 280. Just
280.
after 1 year. Therefore, what happens? It then means that there is a temporary what? Difference.
Different.
Of how much? Carry amount is greater than what? Tax base. Abi?
Yep.
Yeah.
By how much? 120. Abi?
120.
Now, the question is, this difference, is it taxable or deductible? Let us go back to our table.
It's taxable.
These are table.
It's taxable because it's an asset.
Okay. Now, it is taxable, Abi, because
Yes,
it's an
sir.
asset and the kind amount is
Yes.
what? Greater. Which is the same thing as here,
Yes.
taxable, given that the kind amount of an asset is greater than the tax base. Okay,
Yes.
thank you. Therefore, it means in that manner, I'll simply come here and say, this difference is what? Taxable temporary what? Difference. I remember, taxable temporary difference will give rise to deferred tax liability. Is that not?
Yeah.
Because deferred tax liability is tax rate times taxable temporary what? Difference. Which is 30%
times
what? 120. What does that give me? 36. Now, this is based on the simple understanding of deferred tax. Now, let's now use it to answer this question. And let us see what our answers will likely be without preempting anything. They said, which of these following statements is or are less likely to be correct? Provision for deferred tax relation of the asset is 36. Do you see anything like 36 million?
Yes.
Which means this statement is correct, Abby?
Yes, sir.
Yes.
The tax base of the assets is 280. Do you see anything like 280?
Yes.
Yes, sir.
The deductible temporary difference is 120. Do you see anything like 120?
Yes, sir.
Yes, but not deductible.
But not deductible. And do you see anything like taxable
Yes.
at
Yes.
120? Therefore, which
Yeah.
one is odd one out?
C.
C. C is out.
Okay, that's correct. C is out. That's just very simple. Now let's look at this. I want you to use your understanding to solve this problem. Question 10. I'll give you 5 minutes to attempt question 10. And another 2 minutes to attempt question 11 so that we can now discuss the two together. Okay. Can we move on?
Yes, sir.
Okay. The first one. Workout. I think that's question 10. Workout Limited starts a business on 1st of January 2017. In its first year, it makes accounting profit of 30 million. Accounting profits. And this was after charging accounting depreciation of 4 million. And tax depreciation granted in the first year, that's capital allowance, was 6 million. And we are told that the cost of the plant was 20 million. And tax rate was 30%. The first question says, what is our deferred tax for the year? Now, to determine deferred tax, what do? I look for the carrying amount of the plant, which is my cost of the plant minus accumulated depreciation. This gives me 20 million minus 4 million. That gives me 16 million. The tax base is the cost minus capital allowance, which is 20 million minus 6 million. That gives me 14 million. Now there's a temporary difference of 16 million minus 14 million, which gives me 2 million. And this temporary difference is taxable because of what? The current amount of an asset is greater than the tax what? Pays.
Yes.
Okay. And what is the tax rate?
30%.
The tax rate is 30%. Therefore, my deferred tax liability will be 30% of 2 million, which is how much? 600,000. Now, this is my liability at the end of the year. But remember, what I wanted is the movement in my deferred tax liability. We did that in earlier examples we did today. And how do you do that? I compare my opening balance with my closing balance. What is the opening balance? Is nil, because we are not giving information, we just started the business. But my closing balance is how much? Is 600,000. Therefore, is it an increase or decrease? It's an increase in liability. Is that not? Of how much? 600. An increase in liability is a deferred tax what? Charge. That is an expense. If it's a decrease in liability, is an income or credit. Remember the initial example we did, which means my deferred tax charge to revenue 17 is 600,000 naira. Second question says, what is our current tax? Remember, in computing current taxes, what do you do? To compute my current tax, I start with my accounting profit. What's my accounting profit? 30. This profit was, depreciation is not liable because it's replaced with capital allowance. Therefore, I'll add back depreciation. How much?
4 million.
4 million. There's no other adjustments. This gives me my adjusted profit. Now I'll deduct capital allowance. That give me what? 28 million. And that give me my taxable profit. Now what's my estimated tax? 30% of 28 million. How much is that? Can somebody calculate that?
Eight point 4.
8.4.
Yeah.
Okay. Now, C says my income tax. My income tax expense for that year. Off we go in thousands. Is my current taxes, which is what? 84. And my deferred tax, which is additional charge 600. Therefore, I have my total income tax to be how much? 9,000. Now, can you relate to this 9,000? What was my accounting profit? My accounting profit was 30 million.
Yes, sir.
Is that not?
Yes, sir.
Yeah.
Now, if I apply this 30 million, let me multiply it by my tax rate of 30%. What will it give me?
9 million.
9 million. Now, what we are trying to say is this. The difference between 9 million, that is a tax rate on accounting profits, and tax rate on taxable profits, would give you 8.4 million. The difference between 8.4 and this 9 million is our deferred tax of income, which means deferred tax is to cover the gap of non-completion of the recognition of all of the tax consequences in a particular period. Which means tax authority says, based on actual taxes, you'll pay 8.4. But I am aware that my total tax consequence is 9 million. Therefore, it's now additional responsibility on me for me to recognize by accrual principle additional 600, pending when it crystallizes in the future. And that's what we're trying to do. Which means accrual constant is saying recognize all your costs as they are incurred, regardless of what portion of it is required for you to pay. Are you getting what I'm saying now? And that's what we're trying to do. That is, if I've just decided to recognize 8.4 from the government perspective, I won't be reflecting in my financial position, my financial performance, the actual amount of tax, which is 9 million. But what I'll do is that by way of accounting measure, I'll now have to make an accrual adjustment by recognizing deferred tax. And what does deferred tax stand for? It stands for the fact that there's additional 600 that will likely crystallize on me in the future. By the time the temporary difference that brought about the difference today arises, which then means that I already have a present obligation in recognizing it. That is why I need to do it now, which go in line with the provision of IAS 37. You make provision once you have a liability, though it's of uncertain amount or timing, but there's an obligation that is present. And that's what we're trying to do. But this is just a simple way of explaining what the deferred tax is and its implication. Any question before we look at something I'll give you as an assignment, and we'll start from it in the next class. And there's likelihood that we might have a class during the week, but it's going to be sometimes probably 6 or 7 p.m. to look at that assignment. Somebody said, what's the issue?
6.
You don't get to before
Yes,
6 or 7?
We'll be on our way from work.
What time do you get to averagely?
Averagely 8 o'clock. Most of us.
We can do something for 8. Okay, now the assignment is this. I'm going to send you the material, but this is the assignment. You can snap it if you wish. Okay, we've not answered question 11, but I'll do that before I go. But this is the assignment. This is the assignment. You can snap it if you wish.
That's true.
Okay, I think we've snapped that, but I'll still send it to you guys. Now let's go back to the last one before we call it a day. That's question 11. NIA PLC recognizes provision in accordance with IAS 37 of 1 million on its product warranty issued on the sale of mechanical device made in 2017. In accordance with relevant tax law, this product warranty cost, as estimated in IAS 37, will not be deductible for tax purposes or cost, which means it is only allowed on a cash basis. The corporate tax is 30%. Describe the different tax implication of this. Very simple. Now, provision for warranty falls under IAS 37. Okay? It falls under IAS 37. Now, in that light, provision is a liability. Provision for warranty cost is a liability. We must first of all recognize that fact. Now, the carrying amount is 1 million naira. Now, the next question is for us to ask for the tax base. What will be the tax base? The tax base, later on, we are going to, I'll give you the material, you will go and study more on what is tax base. But tax base is simply the amount of an asset or liabilities for tax purposes. Now, in this case, the tax law says such a cost is not allowed for deduction because it's just a mere provision that has never occurred. But such warranty cost will only be allowed for deduction whenever an entity actually pay for replacement, pay for repairs, or etc. But in line with IS 37, based on our experience, we make provision for liabilities of uncertain amount and timing. In that regard, what we then need to do is to recognize 1 million, as we have done in this case. But for tax purposes, such liability does not exist because it has not yet crystallized. In that situation, what happens is that the tax base of this liability is nil. It does not exist. If that is the case, nil implies it is zero. What then happens is that we have a temporary difference, which is the difference between the carrying amount of a liability which is greater than the tax base. By how much? By 1 million. Because 100 minus 0, 1 million minus 0 is 1 million. Therefore, what are we going to consider this to be? It's going to be considered to be a deductible. A what? A deductible temporary difference. Remember, it is deductible because the carrying amount of the liability. Let me show you the diagram again. It's deductible because the carrying amount of the liability is greater than the tax base for the liability, which gives us this deductible. Okay. Now, if it's deductible, therefore, what does that shows us? It shows us that we'll have to recognize deferred tax assets, which is the tax rate of, what tax rate is it? 30%? Is it 30? Yes. Times the deductible temporary difference. That is 1 million. 30% of 1 million is what? 300,000. Which means your implication you are going to describe is that first, this transaction gives rise to a deductible temporary difference of 1 million naira. And given that the tax rate is 30%, the entity will have to recognize a deferred tax asset of 300,000, which is as a result of 30% of 1 million naira. Any other question? Any other question? Any other question? Okay, in the absence of no question, who can just summarize what we discussed today? Who can summarize what we discussed today? I want somebody to summarize it. Who will summarize what we have discussed today? Hello. You guys are not talking, no interaction. Any commentary?
Okay, so I'll attempt a summary.
Okay.
So basically, we talked about how to compute income tax, what comprises income tax, as well as how to compute the components. So told us that basically income tax would comprise of the current tax and the deferred tax. And then we walked around how to compute the current taxes, which basically involves the adjustments to the accounting profit, and then the computation for deferred taxes, which could result as either a deferred tax liability or a deferred tax asset. How to now decide if it's a deferred tax liability or deferred tax asset? You give us a matrix that would guide us. Yeah, I think basically that's the summary of what we did today.
Okay, who can continue from where it stops? Or pick one or two things to mention?
Okay. We talk about basically income tax today, which is being guided in IS 12. And during that course, talk about definition of tax as a compulsory level on individual and body corporate. Then taxation is the system of tax administration. On that aspect, we talk about different tax. We have consumption tax, revenue tax, income tax, which is our major focus today. Then you make us to understand that for us to talk about income tax, we have to look at profit. And profit is the difference between income and expenses, that you must be able to match income with expenses to get your profit. And that is the basis of having your income taxes. And you give us different examples of income tax, with education tax, with CIT, and rest of that. Then we solve some questions. Then you taught us about deferred tax. That deferred tax is a tax liability that which ordinarily should be recognized in your accounting, in your financial statement, because it's a tax liability that will crystallize in the future. Then based on that, you gave us some presentation of income tax, which you have profit and loss, OCI, other statements of other comprehensive income. You have the equity. You said that most of our income tax is majorly on our profit and loss, and minute of it is on our other comprehensive income. And just in a rare situation, you have it in your equity. I think I will end there for other persons. Thank you very much.
Who else will take it from there? Who else is taking it from there? Yusuf Abdullahi, you want to contribute?
Okay, from where she stopped on deferred tax, you gave us a diagram. You said deferred tax can either be positive or negative, and you give example of a road, typical Nigerian road, and like a road that is not straight, then we have a thin line across the road where we cut off the excess and we fill up the in between. We cut up the excess and we fill up the in between. And you said deferred tax arises from temporary differences, and it could be deductible. Then from there you give us a diagram. That's the deferred tax to the temporary differences. Then from the temporary differences, it can either be taxable or deductible. Then if it is taxable, it can be either deferred liability. If it is deductible, deferred assets. Then you continue with you give us the definition of temporary differences that arises between the carrying amount and tax basis of an asset and liability. Then you said the asset and liability, the carrying amount and the tax basis. You actually gave us a principle which says the carrying amounts and the tax basis have to be equal. But in a case where it is not equal, then you give us a diagram. That's the matrix to be able to know if it's going to be a deductible or liability. Then we did a couple of questions on that.
Okay. Okay, any other question? Any other question?
Hello, sir. Hello, sir.
Or contribution?
Yeah, I have a question, sir.
Okay.
Yeah, I want to ask, in what scenario will our deductible tax be greater than our taxable differences?
No, I didn't get it.
I'm asking that, in what scenario will our taxable differences actually be greater than our deductible tax differences?
No, there's no basis of comparing taxable and deductible. We are saying that there are two sides to a coin. It's either you have a profit or you have a loss. Therefore, there's nothing like comparing loss and profit, loss greater than profit or profit. No, there are two sides to the coin. Your outcome should either be loss or profit. The same way the outcome of temporary difference is either is taxable or is deductible. Is that okay?
Yes, sir.
The only comparison you have is carrying amount and tax base. At what point is carrying amount greater? Is it for an asset? Is it for a liability? Will determine whether it's deductible. And that's why you have to make reference to that matrix. Okay. I think we need to bring it to an end now. Thank you very much. And follow the, I'm going to confirm if on Tuesday or Wednesday, we are going to, probably Tuesday or Wednesday, we are going to meet to wrap up income tax. And we're going to wrap it up by looking at the assignments. That's one. Two, by looking at other topics we've not covered, which is the tax definition of tax base with examples, and looking at limitation and recognition of deferred tax and some other things. Those are the things we are going to consider as we move on. Is that okay? Thank you very much. And luckily now, this particular lecture is recorded and it's recorded in the cloud. I'll send the link also to you guys alongside with the materials. Thank you very much, and God bless you.
Thank you, sir.
Thank you, sir.